Joining us now, financial expert Mitch Roschelle, CEO of M2 Communities, LLC. Welcome to you. How do you interpret this latest report?
Well, when something comes in line with expectations, it's generally good news because it means that the market and all of us weren't surprised. What the big shoe that everybody's waiting to drop is the belief, which could be a myth, that tariffs cause inflation, and we still haven't seen it. And we're several months into this. In fact, the federal Treasury has taken in $171 billion worth of tariff revenue, which you would have thought would have been passed through to consumers, and we still have not seen that. So I think it's refreshing that inflation really hasn't shown its ugly head again. And it's also a sign that maybe the Fed's going to come to their senses and start lowering interest rates.
There was, though, some data about the apparel index that was up. So clothes, the cost of clothes. What do you read into that number?
Well, we saw it in clothes, we saw it in household furnishings. And I think what happened, and I think I've mentioned this before, a lot of importers earlier in the year, knowing that tariffs were important to President Trump's policy, started importing a lot of goods to get ahead of the tariffs so that they were basically tax-free. And those items are stockpiled. So we're seeing some sectors like electronics and even autos seeing price decreases in this inflation report. And it could very well be that some of those items just, weren't easily importable or weren't ready in the supply chain. So there's a little bit of tariff pushed into those items. But the fact of the matter that it's across the board, we're not seeing it, I think is a good news.
The Fed, as you mentioned, they've been reluctant to cut rates. What specifically will they be looking at as a marker to make that decision?
I think the Fed will look at this report and the PCE index, which comes out in about a week or so, which is their preferred measure of inflation. And generally, these two measures are pretty close. They're going to, sort of dig into the weeds and figure out what's really driving what's left of inflation. They're also going to look at where wages are relative to inflation. And that's actually a silver lining here. Year-over-year wage growth is about 4%, and year-over-year inflation is, based upon this report, 2.7%. So real wages are actually rising. And I think they're going to balance all of that. The important thing for the Fed, if they're listening, is that, shelter costs, which are a big chunk of the inflation report, that's rent, that's the household owning equivalent of rent, is still on the rise. And that's a primary driver of inflation in this report. And a good way to tamp that down is to start lowering interest rates.
How does consumer confidence play into all of this? How people feel? There was so much uncertainty and kind of confusion at the beginning of the tariff talk. Has that seemed to subside?
Yeah, it has. And there's a couple of measures of consumer confidence, consumer sentiment, and they are improving. And I think, like the market, like all of us, we've sort of gotten used to this notion of on again, off again tariffs. And we're not as, I'll use a technical term, freaked out by all of it. And I think that bodes well for the consumer, because a nervous consumer is bad for the economy. And right now, I think consumers are getting used to it.
Yeah. Mitch, good to see you as always. Thank you.